Ever get that feeling, when you're trying to decide where to invest? Like, do you go for something with the potential to be huge, but maybe it's super risky? Or do you play it safe, but maybe you're not going to see that crazy growth?
Oh, absolutely. I think we've all been there, that push and pull, right?
Yeah.
Wanting the big win, but knowing there's a chance you could lose out. That's the whole risk return thing everyone talks about. How much are you willing to risk for the possibility of a bigger payoff?
Exactly. And that's what this deep dive is all about. We have these notes here packed with info. We're going to break down how you actually measure investment returns, figure out how to understand risk, how to measure it, how do those two ideas, risk and return, play together. Then we'll get into smart moves like diversifying your portfolio. Then we'll even look at this thing called beta, which tells you how much a stock moves with the market.
Sounds like a lot.
Oh, it is.
Okay.
And then we'll get to the capital asset pricing model. CAPM.
Yes, CAPM.
Might sound intimidating, but we're going to make it make sense, I promise.
I love it. You really have given us a ton to work with here, and our goal really is to pick out the most important stuff so you can walk away with a solid grasp of these finance fundamentals. No one wants to feel overloaded. We want you to have those aha moments where everything clicks into place.
Think of us as your guides through this world of, some pretty important finance ideas. We're going to dig deep. We'll get into what really drives investment performance and all the risks that come with it. Let's start with the most basic thing. How do we measure how well our investments are actually doing? Returns.
Good place to begin. Now, you might be thinking, why bother calculating returns? Seems obvious, right?
Mm-hmm.
But it all comes back to this idea of WACC, the weighted average cost of capital. Every company needs their investments to make more money than that WACC. That's basically their cost of using money, whether it's from loans or from, selling shares. If you're not measuring returns, you don't know if you're creating real value.
So WACC, like a benchmark, right? Your investment needs to beat that to be worth it. But first, we got to know what return even means. How do you figure that out for a stock?
The most basic measure is called holding period return, or HPR. This tells you the total return you got over a specific time. And it's made up of two things: capital gains or losses, which is basically the change in the stock price, and dividends, those payments companies give out while you own the stock.
Got it. Buy low, sell high, that's a capital gain. And then those little bonus payments from the company, those are dividends. So how do we actually calculate this HPR?
The notes give us a nice formula. Equation 6.1 R equals, in parentheses, P1 minus P0 plus D, all divided by P0. So P0, that's your initial price, what you paid for the stock. Right. P1 is the price you sell it for, and D, that stands for the dividends. The result, R, is your total return for that holding period.
So it's like what I made from the sale minus what I paid plus any dividends, and then you divide all that by what I originally put in.
Right.
And you can break that down even further, can't you?
You got it. Equation 6.2 separates it neatly. R equals, in parentheses, P1 minus P0 divided by P0 plus D divided by P0. So now you can really see the two parts. That first chunk, that's your capital gains yield, the percentage change in price. And the second part, that's your dividend yield, what percentage of your investment you got back just from those dividends.
Okay, time for some real numbers. In example 6.1, you buy a stock for $15, get a $1.20 dividend, then sell the stock for $18. So what's the HPR?
All right, let's plug it into equation 6.2. Our capital gains yield is $18 minus $15 divided by $15. That gives us 0.20 or 20%. Then the dividend yield is $1.20 divided by $15, which is 0.08 or 8%. Add those together, 20% plus 8%. You get a total holding period return of 28%. Not bad at all.
Wow, that's a pretty good return. Now let's look at a real company. Example 6.2, Apple in early 2025. Say at the end of January, it was at $236. You get a $1.25 dividend in February, and then by the end of the month, the price is up to like $241.84. What's your return for that month? Same process. Capital gains yield first. $241.84 minus 236 cents. Divided by 236 centers. That's about 0.0247 or 2.47%. Dividend yield is $0.25 divided by 2.58%, which is tiny, like 0.0001 or 0.11%. Put those together, and the total return for February 2025 was around 2.58%. Most of that gain came from the price going up, not the dividend.
Okay, that makes sense. Now we're talking about 1 month, 1 period. But what if you hold an investment for years, and the return's different every year? How do you calculate that?
That's where compounding comes in. It gets a little more complicated. You can't just add up the yearly returns. You have to factor in that each year's return is building on what you already have. Equation 6.3 shows us the formula for total return over multiple periods, in parentheses 1 plus R1 times 1 plus R2 and so on, up to 1 plus RT, then all of that minus 1. So you're multiplying together 1 plus the return for each period and then subtracting 1 at the end.
Okay, that is a bit more than just adding. So example 6.3, let's say your investment had returns of 10%, then 15%, then a loss of 5%, and then back up to 20%, 4 years total. How do you figure out the overall return? All right, let's plug it in parentheses. 1 plus books 10 times 1 plus 0.15 times 1 minus 0.05, remember it's a loss that year, times 1 plus 0.20. That gives us about 1.4421. Then subtract 1, and you get a total return over those 4 years of about 44.21%. That's how much your initial investment would have grown, percentage-wise.
So like $100 becomes $144.21 after 4 years.
Yeah.
Got it. Example 6.4, we're looking at a longer time frame. 30%, then 22%, then down 10%, another loss of 20%, and then up 40%. 5 years. What's that total return?
Same idea. 1 plus 0.30 times 1 plus 0.22 times 1 minus 0.10 times 1 plus 0.40. That gives you approximately 1.5987. Subtract 1, and you get a total return over those 5 years of 59.87%. Even with those down years, you've got some serious growth thanks to compounding.
Right, those negative years matter, but the positive ones really make up for it. There's this example in the notes that really highlights this compounding thing, right? The one about going from $100 down to $2 and then back up to $4.
Yeah, that one's a classic. It shows why the order of returns matters. You might think a 98% loss followed by a 100% gain gets you back to even, or maybe even a little ahead. But think about it, $100 down to $2, that's a 98% loss, definitely. But a 100% gain on $2 only gets you back to $4. Using our formula, 1 minus 0.98 times 1 plus 1 minus 1 gives you a total return of negative 96%. You're still way down.
So a big loss really digs a hole, and it takes a massive gain to climb out. Speaking of digging out, what if you know you've taken a hit? How do you calculate how much you need to make just to get back to even?
Great question. Let's say you lost 20%, like the notes mentioned. To break even, your total return needs to be 0. So if we imagine 2 periods, the first one is a 20% loss or a minus 0.20 return. We can actually use the total return formula and some algebra to figure out what the second period's return needs to be to get back to 0 overall. Turns out you need a 25% gain in that second period.
So a 20% loss needs a 25% gain to recover. It's not 1-to-1, and the bigger the initial loss, the harder it is to get back to where you started.
Exactly. That's why managing risk is so crucial. Now let's say you're comparing different investments. Maybe you've held them for different lengths of time. Just looking at total return might not be the best way. That's where average returns come in. The notes talk about 2 ways to calculate them: arithmetic average and the compound average.
Arithmetic average, that sounds like the simple one, right? Just add up all the returns and divide by the number of periods.
Yep, that's it. Equation 6.4 lays it out. R bar equals the sum of all the individual returns, Mary, divided by the total number of periods. T, example 6.6, uses Apple's monthly stock data from January to July 2024. The arithmetic average return for those 6 months, February to July, is 2.80% per month.
Seems simple enough, but the notes say this might not be the most accurate way to look at how an investment actually did over time, and that's where the compound average comes in, right?
Right. The compound average return, shown in equation 6.5, factors in that compounding effect we talked about. It basically tells you the constant rate of return you would need at each period to get to the actual total return. So it's a more realistic view of how the investment actually performed over multiple periods. The formula is, open bracket, then in parentheses 1 plus R1 times 1 plus R2, and so on for each period, close parentheses.
Yeah.
All that raised to the power of 1 divided by t, and then the whole thing minus 1.
Exactly. 6.7 really illustrates this. It's that example where you invest $100, it goes down to $50, then back up to $100. So a 50% loss, then a 100% gain. What happens when we calculate the two different averages?
Well, the arithmetic average is simple. Negative 50 plus 100 divided by 2 equals 25%. Looks like you made money, right? But then you look at the compound average. And because of how we account for those losses in the formula, it comes out to 0, which makes sense. You ended up right back where you started. So the compound average gives you a much more realistic view, especially over longer periods.
Right, so the compound average is more useful for seeing how a single investment does over time. And there's this rule, right? The compound average is always less than or equal to the arithmetic average.
That's a key point. They'll only be equal if your returns are exactly the same every single period. Any variation, any ups and downs, and the arithmetic average will be higher. That's why, as the notes mention, investment managers usually have to report compound average returns. It's just a more honest picture of how things really went.
Makes sense. So we've got total return, arithmetic average, and compound average. But how does that total return we talked about earlier relate back to this compound average?
There's a formula for that too. Equation 6.6. Compound average return equals, in brackets, 1 plus the total return, close bracket raised to the power of 1 divided by t, and then the whole thing minus 1. It's handy when you already know the total return over a long period and you want to see what the average yearly return was.
Like in example 6.9, a total return of 59.87% over 5 years works out to a compound average annual return of 9.84%. That's like the average growth rate you needed each year to reach that total return. And example 6.9 shows you can even calculate the average monthly return from the same 5-year total return.
Yep, just change the t in the formula to be the total number of months. In this case, it's 60. And you get a compound average monthly return of about 0.79%.
And even when the total return is negative, like in example 6.01, where a stock drops from $25 to $18 over 4 years, that's a 28% loss. You can still calculate the compound average. It comes out to negative 7.88%. So that's like the average rate of decline each year over that 4-year period.
Right. The formula works even when you're losing money. So now we've got a good understanding of how to measure returns. But the other side of the coin is risk. We need to understand that too.
Right. Return is what we hope for. But risk, well, that's the chance things could go south. The notes start by talking about the difference between risk and uncertainty. What's the deal with that?
People use those words interchangeably all the time. But the notes make a good point. Uncertainty just means not knowing something for sure. Like, will it rain tomorrow? No one knows for sure. But risk is a step further. It means there's a chance of something bad happening, something that could cause harm or a loss. So if you're planning a big outdoor party, the uncertainty about the weather becomes a risk, because rain could mess everything up.
So risk has that element of potential downside. And the notes bring up Frank Knight's definition, which mentions this idea of quantifiable uncertainty.
Yes. Frank Knight was this economist who said risk is when you don't know the outcome for sure, but you can assign probabilities to different outcomes. Like think of insurance companies. They don't know if your house is going to burn down, but they can estimate the chances based on all kinds of data. So risk in this sense is uncertainty that you can actually measure, at least in terms of probabilities. And importantly, it comes with the possibility of some kind of negative consequence.
Okay, so in the world of investing, how do we measure that potential for things to go wrong? The notes talk a lot about volatility.
Volatility is a big one. The notes define it as, liability to change rapidly and unpredictably, especially for the worse. Basically, it's how much an investment's price swings up and down over time. And we often measure it using the standard deviation of its returns.
So if a stock price is all over the place, jumping up and down a lot, it's considered more volatile and therefore riskier.
That's the general idea, yes. High volatility means high standard deviation, which means a greater chance of big losses, but also potentially big gains. It's that unpredictability, the wide range of possible outcomes around the average, that makes it riskier. You just don't know what to expect from one day or month to the next.
And the notes mention 2 ways to calculate volatility: historical analysis and scenario analysis. Let's start with historical analysis.
Historical analysis is all about looking back. You assume that how risky an investment was in the past will give you clues about how risky it might be in the future. So you take its past returns over some period and calculate the standard deviation. Equation 6.7 in the notes shows the formula, the one we usually use in finance. You've got to calculate the average return first and see how far each return is from that average, square those differences, and then do some math to get the standard deviation.
So example 6.12 shows returns of 10%, then a 6% loss, then up 20% over 3 years. The average return comes out to be 8%, and then the standard deviation is about 13.11%.
Right. That 13.11%, that's a measure of how volatile that investment was over those 3 years. Then, example 6.13 compares it to another investment with returns of negative 2%, 12%, 11% over the same 3 years. This one has a lower average return, 7%, and also lower standard deviation, 7.81%. This shows the risk-return trade-off. If you want higher returns, you often have to accept more volatility, and that means more risk.
And for folks who like to use spreadsheets, the notes mention the average and STD-EVS functions in Excel to calculate all this. They also briefly mention example 6.1 form, which used even more data and showed how to calculate various things like the total return and volatility. So historical analysis looks up the past. What about scenario analysis?
Scenario analysis is about looking forward. Instead of relying on past data, you imagine different future scenarios, like what if there's a recession? What if the economy booms? Then you estimate how your investment would do in each of those scenarios. And you assign probabilities to each scenario, like how likely you think each one is to happen.
So it's like if we have a terrible recession, my investment might lose X%, but if we have a huge boom, it might gain Y%.
Yeah.
And you try to put a number on the chances of each of those things actually happening.
Exactly. Equation 6.8 shows you how to get that expected return based on your scenarios. You multiply the probability of each scenario happening by the estimated return for that scenario. Then you add up those results for all your scenarios.
Like in example 6.15, where we've got 3 scenarios for Apple: a 20% chance of a recession leading to a 15% loss, a 50% chance of a normal economy with an 8% return, and a 30% chance of a boom with a 20% return. Based on all that, the expected return is 7%.
Yep. And once you have that expected return, you can use equation 6.9 to calculate the standard deviation across those scenarios. It's a little more complex, but the idea is to see how far each scenario's return is from the overall expected return. Square those differences, then weight them by the probability of each scenario, add all that up, and finally take the square root. Example 6.16, using the same Apple scenarios, shows a standard deviation of 12.17%. Example 6.17 then uses a completely different set of scenarios and probabilities to calculate expected return and standard deviation.
So both historical and scenario analysis give us a way to measure volatility, but the historical approach uses real data, whereas scenario analysis relies on what you think might happen, which is inherently subjective.
That's right. Historical analysis is data-driven, but it assumes that past patterns will continue, which isn't always true. Scenario analysis lets you factor in your own views of the future, but it's only as good as your assumptions. Both methods have pros and cons. The important thing, as the notes stress, is that standard deviation, no matter how you calculate it, is telling you about the spread of possible outcomes. Higher standard deviation means a wider range of possibilities, including a greater chance of those big negative outcomes. That's why we use it to measure risk.
Okay, so now we know how to measure returns and how to measure risk, at least the volatility part of it. But how are those two things related? That's what the risk-return trade-off is all about, right?
Absolutely. The risk-return trade-off is fundamental to finance. The basic idea is, if you want a chance at higher returns, you usually have to take on more risk. We're talking about risk-averse investors here, the average person. They won't take on extra risk unless there's a potential reward. Think about it. If a super risky investment didn't offer a chance at big gains, no one would want it. The price would drop until the potential return was high enough to attract investors willing to gamble.
So in a market where everything is working the way it should, investments with more risk will usually, over the long run, have higher average returns.
That's the idea, as the notes explain. But there's a huge caveat. Higher risk doesn't guarantee higher reward, especially in the short term. What it really means is a wider range of possibilities, good and bad. Over the long term, the hope is that those good possibilities, the bigger potential gains, will outweigh the bad ones, leading to a higher average return.
So how do we figure out if we're getting a good enough return for the risk we're taking? Is that what the Sharpe ratio is for? That thing named after William Sharpe, the Nobel Prize winner?
You got it. The Sharpe ratio, shown in equation 6.1, measures risk-adjusted return. It tells you how much extra return you're getting for each unit of risk, where risk is measured by standard deviation. The formula is RI minus R, all divided by sigma. RI is the average return of your investment. RF is the risk-free rate. Think of it as the return you can get with no risk, like from a government bond.
Yes.
And sigma I is the standard deviation of your investment's returns.
So it's like the return you get above that safe risk-free return divided by the amount of risk volatility you had to take to get it. A higher Sharpe ratio is good, right?
Higher is better, generally. It means you're getting more bang for your buck, more return for the risk you're taking. Example 6.1 looks at those two stocks we talked about before. Stock 1 had a higher average return, 8%, compared to stock 2 at 7%. But when you look at their volatility, stock 1 was much more volatile at 13.1% compared to stock 2's 7.8%. And if you use a risk-free rate of 4%, stock 2 actually had a higher Sharpe ratio, about 0.38, versus stock 1 at about 0.30. This means stock 2 is a more efficient use of your money. You get a decent return without taking on as much risk. It's not always about chasing the absolute highest return. Sometimes a smoother ride is worth more, even if the returns are slightly lower.
So even an investment with a lower return can be a better choice depending on how much risk you had to take to get that return. The notes also talk about visualizing all this on a graph.
Right. You can plot different investments on a graph with expected return on the vertical axis and risk, standard deviation, on the horizontal axis. And the Sharpe ratio actually becomes the slope of the line from the risk-free rate on the y-axis to your investment's point on the graph. A steeper line means a higher Sharpe ratio. better risk-adjusted performance.
Okay, this brings us to portfolios, right? The idea is that instead of picking one or two stocks, you spread your money across different investments. That's diversification, right? And the notes quote some smart folks calling it the only free lunch in investing and a strategy for both survival and aggressive growth.
Exactly. Diversification is a powerful tool. You hold a bunch of different assets, and because they don't all move together perfectly, you reduce the overall ups and downs of your portfolio without necessarily sacrificing potential returns. It's like they always say, don't put all your eggs in one basket.
So how do you calculate the return of a portfolio? Is it as simple as averaging the returns of each stock?
It's actually pretty straightforward. It's a weighted average. Equation 6.11 shows it. RP, the portfolio return, equals the sum of the weighted returns of each asset. Each asset's weight is just how much of your total investment is in that asset. Equation 6.12 shows how to calculate it. The amount you have in a specific stock divided by the total value of your portfolio. Example 6.19 gives you a concrete example.
So if I have half my money in a stock that returns 10% and the other half in a stock that returns 5%, my portfolio returns 7.5%. Right.
And the same idea applies to expected returns. Great.
Got it. The expected return of a portfolio, ERP, is just the weighted average of each asset's expected return. Example 6.20 shows this with two stocks with different expected returns. Remember, your weights always have to add up to 100%. So the notes briefly mention different ways to come up with those expected returns. Historical averages, scenario analysis like we talked about, or even fancier models like CAPM, which we'll get to later. Okay, so portfolio returns seem pretty straightforward. But what about risk? Is the volatility of the whole portfolio just the average volatility of each stock? The notes in example 6.21 suggest it's more complicated than that.
It's a great point. The risk of a portfolio, its volatility, is usually lower than just the weighted average of each stock's volatility. That's a key benefit of diversification. Example 6.21 uses those two stocks we talked about, showing their returns over 3 periods. You make a portfolio with equal weights of each stock. The portfolio's average return is somewhere between the two individual averages, as you'd expect. But the standard deviation of the portfolio is actually lower than either of the individual stocks.
Wait, so just by combining them, the risk is lower than either one alone. That's the whole magic of diversification, right?
Exactly. The reason is that stock prices don't move together perfectly. They have what's called less than perfect positive correlation. Sometimes one stock is down while the other is up, or at least not down as much. This smooths out the overall ups and downs of the portfolio. It's the power of not putting all your eggs in one basket.
So how do we calculate the volatility of a portfolio, specifically one with two stocks? There's equation 6.13, and it looks a little scary.
It is a bit long.
Yeah.
But let's break it down. The formula is sigma p equals the square root of, in brackets, WA squared times sigma A squared plus WB squared times sigma B squared plus 2 times me TA times WB times rho AB times sigma A times sigma B, close brackets. Okay, so sigma P, that's the standard deviation of the portfolio, the thing we're trying to find. WA, WB are the weights of each stock, how much of your money is in each one. Sigma A and sigma B are the individual standard deviations, the volatility of each stock. And the new part is rho AB. That's the correlation coefficient between the two stocks.
Right. We know about the weights and the individual volatilities, but that correlation coefficient, rho AB, it goes from -1 to +1.
Right, exactly. It measures how much the two stocks tend to move together. Close to +1 means they move in the same direction. Very predictable. Close to -1 means they move in opposite directions. Close to 0 means they're basically doing their own thing, not much relationship.
So how does this correlation affect the risk of the whole portfolio?
This is where diversification really shines. The lower the correlation between your assets, the less risky the overall portfolio. If they have a correlation of +1, perfectly correlated, there's no diversification benefit at all, like example 6.23 shows. But as the correlation goes down, you can see in example 6.24 and 6.25, the portfolio's volatility goes down too. The best case is negative correlation, like in example 6.26, where the correlation is -1. That gives you the lowest possible risk for that combination of stocks. That's what we mean by free lunch. Combining stocks that don't move perfectly together reduces risk without sacrificing returns.
Right. If one goes up and the other goes down, the whole thing is more stable. The notes mention that, on average, 2 random stocks will have a correlation of about +0.3.
That's a good rule of thumb. Perfect negative correlation is rare in the real world, but even with that +0.3, you're still getting a lot of risk reduction compared to holding just one stock. Example 6.27 shows this with specific amounts and volatilities. And then there's that NASA example, the one with the parachute packers.
Oh, right. To minimize risk, they wouldn't let all the experts who pack parachutes ride in the same car.
Exactly. That's diversification in action with really high stakes. So diversification reduces risk. But the notes then say there are two types of risk: systematic and unsystematic.
What's the difference? And how does diversification play into that?
This is really important. Diversification helps, but it has limits. As you add more and more stocks, the risk reduction starts to level off. Around 30 to 40 stocks, you're not getting much more benefit, as figure 6.6 in the note shows. That's because, yes, individual companies have their own risks, but they're also all affected by broader things that affect the whole market.
So even with a giant, diverse portfolio, there's still some risk you just can't escape.
Exactly. That's systematic risk, sometimes called market risk. It's the risk that's baked into the whole system. Think about things like the overall economy, interest rates, inflation, big geopolitical events. Those things affect almost every company to some degree. You can't just diversify that away.
Okay, so systematic risk is the stuff that affects everyone. What about the risk you can get rid of? The notes call that unsystematic risk.
Exactly. Unsystematic risk is specific to a company or an industry. A lawsuit, a product recall, a CEO quitting, a new competitor that targets one specific industry. These things only affect certain companies, so if you've got a diverse portfolio, those company-specific problems will be balanced out by the good things happening in other parts of your portfolio. That's why it's also called diversifiable risk, or firm-specific risk, idiosyncratic risk, unique risk. They all mean the same thing. So systematic risk is like the tide. It lifts or lowers all boats. Unsystematic risk is like the waves, affecting each boat differently.
And if you're a smart, diversified investor, which type of risk should you worry about more?
If you've diversified well, you've minimized that unsystematic risk. So the big thing to worry about is that systematic risk, the risk that's still there no matter how many stocks you own.
And how do you measure that systematic risk for a single stock? Is that what beta is for?
Bingo. Beta is all about systematic risk. It measures how sensitive a stock is to movements in the overall market. A beta above 1 means the stock is more volatile than the market. It amplifies market moves. If the market goes up 1%, that stock might go up 1.5%. If the market drops, that stock might drop even more. A beta below 1 means it's less volatile, smoother ride.
The notes say you can calculate beta by doing a statistical regression. You compare the stock's historical returns to the market's returns, and you get this thing called the characteristic line, like figure 6.7 shows for Apple. The slope of that line is the beta. Apple's was about 1.34.
That's right. So historically, when the market went up 1%, Apple went up about 1.34%. Then there's this thing called R squared, which tells you how much of a stock's movements are due to the overall market versus its own specific stuff. High R squared means most of its movement is because of the market. Figure 6.8 shows two characteristic lines, so you can see visually which company has more systematic risk and which has more of its own unique risk.
There's a formula for beta too, right? Equation 6.14, it uses the correlation between the stock and the market along with their volatilities.
Right, the formula is beta I equals rho I M, that's the correlation, times sigma I, the stock's volatility, divided by sigma M, the market's volatility. So a stock's beta depends on how closely it moves with the market and how volatile it is compared to the market. Example 6.29 shows how to calculate Walmart's beta using that formula.
And there are some things to remember about beta. The market's beta is always 1. Higher than 1 means more systematic risk. Less than 1 means less risk. What about 0? What does a beta of 0 mean?
Beta of 0 means that.